What's going on, family? Welcome back to the channel today. Today's video is from my last Ask Your Coach session where I broke down how large investment firms are pulling back from multifamily construction and going into build to rent, and what that means for us small mom and pop operators and how we can take advantage. By the way, I'm Johnny Liner, the military CEO, 20-year Air Force veteran turned full-time real estate investor, and my mission is to help you and your family become the best CEO of your last name and help you build wealth through real estate investing. Make sure you guys comment if you have any questions throughout the video. Give it a like, thumbs up, subscribe to the channel, and let's jump into today's content. Let's go. There's a lot going on in multifamily that with interest rates, there were a lot of transactions that happened the last few years before rates started ticking up in 22, that a lot of we're talking about underwriting and looking at the numbers, because a lot of people had aggressive underwriting in order to get the deal done, that they projected, hey, the capitalization rates were going to still be fairly low, and the exit when they got ready to refinance or when they got ready to sell the property, that the interest rate environment was going to be 4%, 5%. And now we already know the last 2 years rates have been anywhere between 6 and 7%, and they didn't put that level of I won't say scrutiny, but they weren't that conservative to project using rates that high on the impact of what the deal would look like when they bought it. And so it tripped up a lot of people. You're seeing foreclosures that happen. I think the crazy part that happened, that, with any operator, they weren't able to predict, especially in certain markets like Florida, California, where not interest, but insurance doubled, tripled the last couple of years, just with all the natural disasters. And so it was things like that where operator could have predicted that their insurance was going to double or triple, and it puts you in a bad place as an operator, especially then if you're in like a growth market of like a Austin or Dallas, where you had a lot of inventory coming online that was brand new. People had a lot of options. Rents started going down progressively because there was so much inventory. People had to lower rent just to lease up. And so if you're in one of those markets like that the last couple of years, it could be extremely painful. Your occupancy is going down. You're not able to make your renovations. Your insurance costs is going up. Your taxes have increased on you. And now all the time, all that's dragging your cash flow down. And, subsequently, we've seen a lot of foreclosures. Not as many as a lot of people had projected with the pain, but a lot of people, extensions, extend, they say right now, extend to pretend, until rates go down. But I think rates are going to be here kind of steady where they are now with the tariffs. With the inflation projections, they're saying inflation may get back up to 5%. That's great for real estate investors, by the way. But where the economy is potentially, and the expectancy that we could see rates for higher, which just puts, depending on your deal, you could be in a tough place, which goes into number three with the multifamily pivot, that we're seeing a lot of institutional money and a lot of investors that are looking to pivot from the C class value add proposition with multifamily. You take a multifamily property that may be 10, 20 years old, 30 years old, and renovate it, increase the rents, then now they're going directly just build to rent. And with the high interest rate environment, with the increase in construction labor costs, the increase in materials, that right now is getting very, very cost prohibitive to do these type of deals right now. And just where interest rates that, when you look at, hey, if the bank's only going to give you half of your money or 60% of your money, then now you got to go raise the rest of that equity on these bigger deals. And that's why I love smaller apartment complexes, because guess what? I don't need to go raise a lot of equity. I can get into the deal and I can get out and really quickly. And I don't have to go and raise a whole lot of money. I don't have to go and get a bunch of partners. And guess what? Then I can just cash flow it and keep it moving. And so the pivot is happening, but just because of the nature of the environment. And so that's the thing, that you can't be a 2025 investor investing now and still have a 2020 mindset. That you got to grow. You have to grow and evolve with the economy. And because real estate is cyclical and it's constantly evolving, and if you're still stuck trying to do fix and flips and thinking you're going to go out here and you're going to sell a house that you're going to have 10 offers on day one, then yeah, the market's changed and you're going to get left behind, and those are going to be some painful mistakes. And so that's one of the things that you see with that. But there has definitely been a rise in the build to rent communities out there, and definitely in like the Nashville's, the Houston's, the Dallas, the large markets where we're seeing a lot of job growth and a lot of population growth, that you're seeing these build to rent communities. Because right now in America, this is the most, I would say this has been the point in time right now where it has been least likely for you to be able to buy an affordable home. That the gap on affordability from what it costs to own a home versus rent has never been this wide. And so right now, more people are looking to rent because they can't afford to pay a 7% interest rate. The average house, what, 400K? They can't afford to that. You need to be making 125, 130,000 a year, and I think the median wage, household wage, is still what, 60,000. So yeah, most people can't afford to buy right now. And I know in our market, when we were looking right now, the last 23, 24, there's a total of 24 units that permits were given out for new construction and multifamily. But also, one of the things that data provider gave us was right now, 80% of the people in that market say they can't afford to buy a home. So guess what? Now you're gonna have 80% of the population looking to rent versus buy. And so for landlords, that's great. That's a great place to be. And with the institutional money, they have a lot of the money that can go and buy 100 houses to be built in an area right now with the institutional buying trends. And that's one of the things we saw with COVID. They started buying single family homes because guess what? The government printed all this money, and and they knew, hey, inflation is coming with this much quantitative easing and stimulus being put into the market. And guess what? Inflation's happening, and guess what? Real estate is one of the best hedges against inflation. So they started buying real estate. And so the thing is, like, as these institutions shift their money and the smart money, and you're getting educated, and you just follow the wave. You understand where Congress is going with the taxes, because tax laws are set up to incentivize investment in certain areas. Because guess what? The government doesn't want to be a landlord, so they incentivize real estate. They give landlords write-offs for all their expenses. They can write off their mortgage interest, as well as they give them depreciation. And one of the great benefits that came out of the Tax Act of 2017 that they're looking to renew this year was 100% bonus depreciation for commercial real estate. And so that's a phenomenal strategy on how to defer taxes. And when you're buying these commercial assets, that is really, really impactful to your bottom line. So the pivot to build a rent, something definitely to be watching. And one of the things that, for those that are out there, great questions, looking to get more clarity before making the next move. Or, well, some people, if you wish you had a game plan, maybe you have equity in your home, like, how do I leverage a HELOC to go to the next level or to do our first project? And, and that's one of the things. My wife and I, we're coming up on, in June, it'll be 10 years since we did our first fix and flip together. So if those are some of the questions that you're having, then we'd love to have a conversation, kind of jump on a call, kind of understand what it is that you're doing, give you my 2 cents from my experience with being a real estate investor, single family side, multifamily, raising capital, all those things, what I would recommend, and kind of go from there. So if that's something you're interested in, definitely tap into the link there, johnnylineham.com/consultation. And yeah, have a one-on-one call with myself, and just see what's out there, and kind of give you some things to think through on how to go to the next level. And then potentially, if you're a good fit, we're looking to be one of our clients. We'll kind of share what that looks like and how to go to that next level as well too. With that, if there aren't any more questions, I appreciate your time. You all have a great night, and we'll see you on the next video. Let's go and let's make some equity happen together.